Hi there, Wayne Wright here. Let me explain something that confuses a lot of buyers. Stressed DSCR. DSCR actually stands for debt service coverage ratio. It's basically your cash flow divided by your loan payments, and lenders typically want to see around a 1.25 coverage or better. But here's the key. Banks don't underwrite your deal based on everything going perfectly. They actually stress test it. That means they may reduce your cash flow by 10 to 20%, or assume higher operating costs, or even plug in a higher interest rate, especially in today's environment. Then they rerun the DSCR. So a deal that looks like a 1.4 coverage ratio, for example, might drop closer to a 1.10 under stress. And that's where things change. If the stress DSCR is too tight, the lender may lower the loan amount or require more equity, or say push for an additional structure like a seller note. And this is one of the most common reasons deals get reshaped late in the process. From our side at Wright Business Advisors, we try to think through this up front, and if we can position the deal to hold up under a lender stress test, it dramatically increases the likelihood of getting it closed. So if you're looking to sell your business, or you're looking to purchase a business and you want a quick sanity check on how a lender is going to view it, feel free to reach out. Happy to help.